With the unemployment money going away, and now the Federal Reserve Bank coming out and saying that they want to stop bailing out the stock market every single month, you have some experts saying that this could lead to a stock market correction or even a stock market crash. So let's talk about what's going on. What's up, everybody? I am Jasprit Singh from theMinorityMindset.com, where money minds rethink rich. The stock market has been on edge for a while. I mean, we still have talks about the Delta variant and how that's going to affect the economy. You have the uncertainty in the Middle East. You have talks about the Federal Reserve Bank no longer bailing out the stock market every single month, and now you have the free money for people going away, which means people might have less money to go out and spend, which will hurt companies, which could ultimately hurt the stock market. Just take a look. Yahoo Finance says that a Citibank strategist warns of a 10% September plunge in the stock market. CNBC says that the market action that we're seeing right now is the same as 1999, and it could lead to a 10 to 20% correction in the stock market. And on Bloomberg, Michael Burry, the famous investor, warns about the mother of all crashes coming to the stock market. See, the stock market and the economy are similar but different. The stock market is the place where people go to bet and invest their money on the future of the economy. But the whole idea of the stock market being directly aligned with the economy is false, because sometimes you're going to have the economy way up here and the stock market down here. And other times you're going to have the stock market way up here and the economy way down here. It's all about investor sentiment. It's how investors feel about the future of the economy. That's why back in 2020, when the pandemic was in full effect, we saw the stock market rallying because people were optimistic about the future after the pandemic, and the Federal Reserve Bank was also pumping the stock market with billions and billions of dollars of free money. That way the stock market would stop its freefall. But now the concern is we're entering the next phase of this recovery, and in this next phase, companies are going to get less support from the government and people are going to get less free money from the government. And so if people don't have as much money as they did before, because now they're not getting the unemployment money, well, that means people are going to have less money to spend. That means they're going to have less money to spend at Walmart, less money to spend at Apple, less money to spend at Gucci. And so if people are not able to find a way to earn more money, they're going to have to slow down their spending. If they slow down their spending, that means these companies which trade on the stock market are going to show smaller earnings. If they show smaller earnings, well, then investors are going to look at their companies and they're going to say, wait, I'm invested in this company at a valuation this high, but the company's only making this much money. This could lead to a potential stock market correction if people's expectations are way up here and reality is down here. There's 5 factors that you really want to pay attention to which can affect the stock market. The first, like I was just talking about, is the free money going away, because now if companies and people have less cash in their hand, they have less money to spend. And not only is this less money to spend at stores, which could affect the store's earnings, it's also less money that people have to go out and invest in the market. So that's one thing you want to pay attention to. The second thing is the Federal Reserve Bank bailouts. Every single month, the Federal Reserve Bank is printing billions and billions of dollars, and they're taking this free money and they're pouring it into the markets to keep investors confident and to keep the market high. That way people keep putting more and more money in the market. But now the Federal Reserve Bank is talking about stopping the stock market bailouts, which could affect how the stock market is doing. Because remember, the price of any asset depends on supply and demand. When you have a lot of demand, buyers, that will push the price of an asset up. So if the Fed stops pouring money into the market, that could lower the demand, which could hurt the stock market. Third is uncertainty. One thing that investors hate is uncertainty in the market, and the concern that people have about the market is the Delta variant and everything going on in the Middle East. Fourth are the loan forbearance programs coming to an end, because these forbearance programs allowed millions of Americans to put their mortgages and their student loans on hold. Now, when you don't have to pay your mortgage and your student loans, you have some extra cash, where now you can take some of this cash and put it into the market. But now if you don't have this extra cash to go out and spend and put it into the market, that's going to put less money coming into the market, which could ultimately affect the stock market. And the fifth thing you have to understand is taxes, because Joe Biden wants to raise taxes, and that could affect the stock market. So let's talk about these 5 things, starting with number 1. But before we get into that, I need you to do me a quick favor and smash that thumbs up button below. I also want to let you know that we just launched a brand new program that we've spent a lot of time building. It's called Stock Market Insiders. The The whole idea here is now you will have access to very successful stock market coaches and a community of stock market investors. See, the problem is if you wanted to learn from somebody who has $1 million in the market and you wanted to spend an hour with them every single week, that would easily cost you thousands of dollars. But I wanted to create a program where now you can have a group coaching session with these type of mentors who are very experienced, who know how to research companies, analyze companies, read earning calls, and they'll do it with you every single week. And you'll also have access to a community of other stock market investors, and you can have access to all of this for less than $50 a month, which is less than the cost of you going out to dinner with your spouse. This is the most value-packed and affordable program in the financial space, and you have no commitments. It's month to month, and if you don't love it, you can even have your money back. You have a 30-day money-back guarantee. So if you're interested in learning about how you can invest your money for the long term, how do you research companies, how do you read earnings calls, and how do you find undervalued companies, this is where you can do that, and you will get weekly coaching, and you'll also have access to a community of other stock market investors. So if you want to learn more and see how you can join for less than $50 a month, I'll put the link to how you can join our stock market insiders in the description below. During the first week of September, 7.5 million Americans lost $300 a week or more in unemployment benefits. Now, to understand the real effect of this, there's two different ways that you need to analyze this. You need to analyze this on the consumer side, and then you also need to analyze this on the investor side. So let's start by analyzing this on the consumer side. What does it mean when you have a huge chunk of America, 7.5 million Americans who are relying on the unemployment money, in this case an extra $300 a week from the federal government, who are no longer making this $300 a week? Well, if you're unemployed, the whole idea is you're going to be using this unemployment money. This is the money from the federal government. You're also getting some money from the state. You're using this money that you're getting from the government, and you're going to use this money to pay for your bills. You're going to use it to pay for your mortgage. You're going to use it to pay for your rent. You're going to use it to pay for your car, your groceries, your phone bill, and everything in between. So this is the money trying to just keep you afloat. That way you have money to eat and pay your bills, and hopefully have a little bit of money to go out shopping. I mean, that's what this extra money was for. It was to help stimulate the economy. That way you could maintain a decent lifestyle, meaning not only do you have money to eat, but hopefully have a little bit of money to shop. Now, this is going to depend on where you live, because if you live somewhere expensive like California or New York, you're not going to have the money to go out and spend. But if you live in an area with lower cost of living, well, now you have some extra cash that you might be able to go out and spend with. So now, if 7.5 million Americans lose out on $300 a week, that means 7.5 million Americans just got a pay cut. If you get a pay cut, you don't have the ability to go out and spend the way you did before because you don't have the same money. That's $1,200 less a month going to Amazon and Kroger and Walmart and Target and to your banks, you know, the big banks, because these are the ones that you have to pay your interest back to on your debt. And so people have less money. That's less money going to these companies, which means these companies will be making less money. Now, the thing that makes this really tricky, and the reason why this is a question mark, is because you had 7.5 million Americans on unemployment relying on this extra $300 a week from the federal government, but at the same time, you have right around 10 million job openings. So it is one of the weirdest economic environments that I have ever witnessed, because right now you are in an environment where lots of companies are looking for work. Companies are begging for labor, but you have a lot of people that are not working. Now, there's a lot of reasons why people aren't working. Maybe you can't get a job. Maybe you have to care for your kids, or you have to care for a parent, or maybe you're scared of getting sick, or maybe you're just sitting at home saying, hey, I'm making more money because of this than I would be if I went out working here. And so you're not going out to work. Whatever the case might be, the reality is now that 7.5 million Americans have just got a pay cut. So now the question is, what's going to happen here? Are 7.5 million Americans going to stick with this pay cut where they're no longer getting the $300 a week, which means you would see 7.5 million Americans spend less money and lower their standard of living, which means these companies that I just talked about would be making less money? Or does this mean that these people are going to go out and they're going to get a job, and now these companies have more labor, that way they can go out and produce more revenue, and these people have more money, that way they can go out to spend? If it's the latter, if people go out and they get a job, they make more money, they have more money to spend, and companies are able to produce more products, that's great for the economy, that's great for the stock market, and it's great for people. If people don't do that, they say, you know what, I don't like going back to work for whatever reason, or I can't go back to work, and you have a big chunk of these people that are now just making less money. Well, that's not so good news for the economy, and it's not so good news for the stock market, because now companies are not going to be making as much money. On the investor side of things, you don't see this as much with the unemployment money, but anytime people get free money, a portion of this free money now is going into the stock market. And the way the stock market works, like I mentioned a minute ago, is it runs on supply and demand. When you have more buyers in the stock market than sellers, then this pushes stock prices up. When you have more people selling stocks than you have buying, this pushes stock prices down. So the stock market, especially in the short term, runs on emotion, because when people get really excited and they want to buy, this pushes a lot of buyers into the market, and this pushes stock prices up. Well, when people have less money in their hand, they have less money that they can invest in the market. Now, again, you don't see this as much with the unemployment money, but anytime you see free money coming from the government, especially now, some of this money is going into the market. Like when the stimulus checks were going out, almost half of every stimulus dollar that went out to young people went right back into the stock market. And so if this free money stops going out, then people are going to have less money not only to spend, but also to invest. Because you have to imagine that there is a portion of people that are getting this unemployment money, and they're taking a little bit of each of their unemployment check and they're sending it right into the market. Well, if this money goes away, well, they're not going to have the money to put back into the market, which goes back to this question. Are people going to go back to work? That way they have more money to invest back into the market? Or are they not? Remember, supply and demand is key when it comes to the stock market, because if you own a stock, let's say you own the Apple stock, and everybody wants to be an investor in Apple, well, now you're going to be able to sell your stock for a higher price because people are fighting each other to buy your shares of the Apple stock. But if Apple starts tanking, they release a really bad iPhone, and people don't want to own the Apple stock anymore, well, now you're going to have a tough time selling, and you're going to have to cut the price of your stock to get a buyer. This is why supply and demand is so important. And this brings me to number 2, understanding the Federal Reserve Bank and their bailouts for the stock market. Every single month, the Federal Reserve Bank prints $120 billion, and then they take this cash and they inject it into the markets. That way investors stay confident in the market, because they know that you have the Federal Reserve Bank printing money, throwing it into the market and buying up assets. And so when you have a buyer who's putting in $120 billion into the market, it's easier to keep the stock market afloat, because you have this huge buyer coming in every single month who is just flooding the markets with cash. But now you're starting to see a different tone in the Federal Reserve Bank, and they're talking about tapering down this money that they're printing, that they're pouring into the markets. Now, the reason they've been so hesitant to stop this, even though they feel that the economy is recovering, is because they don't want to see a temper tantrum. It's kind of a funny saying, but back in 2008, you saw the same thing happen. During the 2008 crash, the market crashed, and then the Federal Reserve Bank came out and they started printing money and they started buying up assets to make investors feel more confident to put their money back into the market. So the Federal Reserve Bank wanted to bail out investors because they don't want investors to lose money. So the Federal Reserve Bank kept printing money, and they kept putting it into the market, and then one day they stopped. And when they stopped, this caused a stock market sell-off, and the Federal Reserve Bank didn't like that. And they named that sell-off the taper tantrum. And so what the Federal Reserve Bank is trying to do now is they're trying to avoid that type of taper tantrum by kind of easing their way out of the market. So they know that this extra money that they're printing is causing inflation, and they know that it's making investors rely on this free money from the Federal Reserve Bank to invest their money into the market. But now they're starting to see that, hey, there's a lot of inflation going on, and this could be doing more harm than good. So maybe we, the Federal Reserve Bank, should start tapering back on these asset purchases, and that's what they're talking about doing now. So you can expect that over the next 12 months or so, that we're going to see this figure start to reduce and maybe even go down to zero, which means you're going to see less money going into the market. So unless this is picked up by more confidence from investors, then that could cause a little stock market correction, because now you have less buyers, less demand, less dollars going into the market, just because the Federal Reserve Bank isn't printing $120 billion every single month to put into the market now. The third factor that you want to pay attention to is uncertainty, because one thing that investors hate more than anything else in the market is uncertainty. I mean, just think about the 2020 pandemic. When the pandemic first hit, nobody knew what the heck was going on. Nobody knew if the economy was going to shut down, if it was ever going to open back up. That uncertainty caused so many people to sell their stocks, which created a mass panic and sell-off in the stock market. Investors hate uncertainty, and the uncertainty factors that we have to pay attention to right now are, for one, the Delta variant, and second, the international uncertainty with the tensions rising in the Middle East, and now kind of a whole bunch of different conflicts going on in the world. It's crazy that we're still talking about this pandemic and its effects on the economy, but it's reality. I mean, this virus is continuing travel bans around the country, is continuing to cause issues with imports and exports, which makes it harder for businesses to run and get products and to get supplies from around the world, and it's also tougher for businesses to sell physical products to people overseas. And so this variant is now only making it harder for travel businesses and hospitality businesses because people don't want to travel internationally, and even if you do, some governments are not going to let you go there and some governments are not going to let you come back. So this variant is still affecting the economy, and if it's affecting the economy, it will affect the stock market, and that means companies are not making the money that they could be if the world was open, and there's only a certain amount of time that companies can survive with small revenues, because now you're seeing the government pulling away with the free money. And so now if you're a company that relies on this type of travel, or if you're a company that relies on people to be able to go into the office freely, like let's say you're a restaurant that relies on people to go back into the office, but companies are not letting people come back to the office because they're scared of their employees getting sick. Well, now you're a restaurant that doesn't have people coming in for lunch because no one's coming into the office. So this is affecting businesses not only within our own country, but globally, because now if you're a company that relies on a company in Asia to send you products, but this Asia manufacturing plant is shut down because of this virus, well, now you can't get your products, which means you cannot produce whatever it is you're making, which means you don't have anything to sell, which means you're not making any money, which is not good news for your company. The second is everything going on internationally. Forgot the second half of that word, where you have tensions going on in the Middle East, which has been going on for a while, but now obviously with the United States leaving Afghanistan, this has caused more tensions, and that's always something you want to be aware of. The reality is war is a business. When Donald Trump came into office, you saw companies like Lockheed Martin, which is one of the biggest producers of army equipment, shoot up in price because President Donald Trump promised that he was going to make the military stronger. So they invested a lot of money into new arms and new equipment and new machinery, and which meant a lot of money was going to companies like Lockheed Martin. It's a shift that you want to pay attention to, and you want to understand how international relations can affect companies, which can ultimately affect the stock market. I mean, it's crazy, but the reality is everything is a business. The fourth factor that you want to pay attention to, which can affect the market, is the forbearance program coming to an end. So just like what I was talking about before, the forbearance program allowed millions of Americans to no longer have to pay their mortgages and to no longer have to pay their student loans. This is great news, especially if you're working a job and you don't have a financial hardship, because many financial advisors were telling people, hey, use this as an opportunity to take that extra cash that you don't have to send to the bank and use this to invest in the stock market, or use this money to pay down your debt, or use this money to save some cash. So you had a lot of people that were in the forbearance program, whether it's for your mortgage or for your student loans, not paying any money. So now instead of paying $1,800 a month for your mortgage and $700 a month for your student loans, you take that extra $2,500 a month, you spend an extra $500, and you take that $2,000 and you put it into the market. Or maybe people were taking the extra $2,500 a month and they were spending $2,200 and they were saving or investing the other $300. Regardless, what this did is it gave people more cash in their pockets today, which gave them more spending power or investing power today, which means if you go to the store and you see the price of your groceries 3 times what it was before, it didn't affect you as much because you don't have the same expenses as before. You don't have to pay your mortgage, you don't have to pay your student loans. So even though you were paying an extra couple $100s for your groceries, it wasn't as painful as it would have been if you were paying your mortgage and your student loans, because then you'd have those extra costs. But since you didn't have those costs, you were able to pay these higher inflated prices, which allowed stores to continue making these high profits and high revenues, because even though prices kept going up, people had the cash to pay it because they didn't have to pay these expenses. But now, as the forbearance program goes to an end, people are going to have to start paying their mortgages and they're going to have to start paying their student loans again, which means now when you go to the grocery store and you see grocery prices 3 times higher than they were just a year ago, and now is when you start feeling the pinch. Maybe you don't buy as many groceries. Maybe you don't go to the mall shopping as much. Maybe you don't go on the vacation. Again, all these things, all this lessened spending affects companies, which will ultimately affect the stock market over the long term unless we see an increase in how much money people are making. Our whole economic system runs on spending, and if people don't have the ability to spend because they don't have enough money to spend, well then this will ultimately hurt the economic system, because now people will not have enough money to go out and spend and buy the things that they want, which means they won't have enough money to go out and do discretionary spending, which means a lot of companies which rely on people having extra cash at the end of the month going there to spend spend. So companies like Lululemon and Gucci, those kind of nicer companies which require you to have some extra cash. If people can't go out and they can't spend, if they don't have money for that extra Starbucks every single day, well then that's going to hurt these companies, which could ultimately affect the stock market unless people have more money or unless their expenses go back down. This also affects the stock market in the sense that if people now have to pay their mortgages and they have to pay their student loans, going to the investor side of things, not the consumer side, that means also people will have less money to put into the market. Now going back to everything that I said before, supply and demand, if people have less cash to put into the market, well, that means you have less demand. If you have less demand and this demand isn't made up for somewhere else, well, this could cause a correction in the stock market just because you have less money going into the stock market. But that's not as big of an issue here than it would be if institutions stopped putting their money into the market because they weren't very confident about people spending their money. But we'll save that for a later video, which is why if you haven't subscribed to our channel yet, make sure you do that. And the fifth thing that you want to pay attention to is taxes. Now, this one is really interesting because Joe Biden wants to raise taxes. But the issue that he's facing is that we're also on a very choppy economy. And if you raise taxes in a choppy economy where businesses are still struggling to find employees, businesses are still struggling to make money, and people are still struggling to get by, and now all of a sudden everybody has higher expenses, that could really slow down the economy when the economy needs to be growing quickly. And so on one hand, you have President Joe Biden who wants to raise taxes. On the second hand, you have an economy that's on really choppy waters, which makes it harder to raise taxes. And on the third hand, you have a lot of investors that are paying close attention to these potential taxes because that can affect when people sell their stocks. We have not seen an official tax proposal by our presidential administration yet, but President Biden has said that he wants to raise taxes on wealthy people and he wants to raise investment profit taxes, meaning he wants to raise capital gains taxes, which means if somebody has a lot of money in the market and they have a lot of profits in the market, because right now the stock market is way higher than it was 6 months ago or a year ago or 10 years ago. And so if you have somebody sitting on millions of dollars worth of profits, they could potentially see their tax rates double if and when this new tax proposal goes through. Well, as our economy starts to recover, chances are you're going to see more talks of taxes start to come out. And if we start to get closer to a higher tax bill, then this could incentivize a lot of investors, especially your larger institutional or your larger wealthy investors who have millions and millions of dollars in the market, to cash out of the market and take their profits at a lower tax rate than waiting until the new tax year when the new tax rates are imposed and then pay twice as much in taxes. Because right now, if you make a lot of money in the stock market, the max you will pay is 20% in taxes. If you make $1 million, you're going to pay $200,000 in taxes. But what President Joe Biden says he wants to do is he wants to double that. So instead of paying $200,000 in taxes, you would have to pay $400,000. And if we're talking about an institution holding on to hundreds of millions of dollars worth of profit, well, that's a lot of money that they'd have to pay in taxes if they sold later rather than sooner, which could trigger some people to sell their assets sooner just because they don't want to pay those higher taxes later on. Now, again, this isn't an issue that we've run into yet, but you have to imagine that as we finish this phase of our recovery, this is going to be the next topic, and this is going to be the next thing that can affect the stock market, especially in the short term. Now remember, if you're a long-term investor, what you need to do is you need to remember your goals and you need to understand what's a good company and hold on to this company for the long term. And even if you see a stock market crash, the only thing you should be doing is coming in and buying more. You do not want to be the person that turns into a trader as soon as you start to see your portfolio in the red. What you need to do is remember what your investment goal is, remember why you invested, and understand that when you see a crash, that's a great time for you to come in and buy. And if you do want to learn more about how to invest your money in the stock market, not only do we have a free guide on how you can invest your money in the stock market, we also have a stock market insiders group that I talked about earlier in this video. So if you want to read our free guide or if you want to join our stock market insiders community, I'll put the links to how you can do that in the description below. If you love that video, then you're definitely gonna love this. If you ask any successful stock market trader or investor, doesn't matter if we're talking about the short term or long term, anybody who successfully has made money in the stock market over history, they will all tell you that making money in the stock market is just as much strategy as it is psychology. And the reason why that's important is because you can have the best stock market strategy. You can pick the best stocks, you can find undervalued companies, but if you do not have the psychology and the ability to control your emotions, it doesn't matter how good your stock pick is. If things start to come down, you're gonna panic sell. Or if things start to go up, you might get greedy and hold for too long, especially in the short term, because in the short term, you can pick great stocks but still lose money. And And you can also pick bad stocks and make money. And now with the amount of news and coverage on the stock market from things like CNBC and Yahoo Finance and Bloomberg, and now we come onto the internet with Reddit and Wall Street Bets and StockTwits and YouTube and Instagram and Twitter, it can be really overwhelming because now you're getting advice from so many different places and you're constantly being bombarded with different things that you should be doing in the stock market. Buy this, sell this, buy this, sell this. You want to make sure that you're not getting into the stock market anxiety where now you're just trying to keep up with everything that's going on because you were hoping that you could double your money in 12 months. The first reason why you should take a break from stocks is if you don't got a stock market strategy. Most people who come into the stock market don't have a strategy on how to trade or invest their money. I know this from experience because the first number of years that I had money in the stock market, I didn't even know that there were stock market strategies out there. The first time I put money in the stock market, I just invested in companies that I knew of or that I heard of. Like the first stock that I ever bought was Ford because I really liked Ford Mustangs. So I figured if I like Mustangs, I might as well invest in the Ford company. Now, I got lucky. I made some decent money off of that stock, but that is not a stock market strategy. Lucky for me, I started to see advertisements of people talking about different stock market strategies on how I could make a lot of money in the stock market. So my next strategy became make a lot of money quickly in the stock market. And the way I started doing that was by trading penny stocks. So one summer, I spent almost my entire summer glued to my computer screen, reading stock charts, reading forums, trying to just trade penny stocks. That way I could make a quick buck. And sometimes I made a lot of money. And other times I lost a lot of money. By the end of the summer, I had either broken even or lost a little bit of money, but I spent a ton of time doing this. I learned a lot, but I didn't make any money. That's when I really started to educate myself in the stock market, because what you have to understand is that when it comes to investing your money in the stock market, you have to understand how to invest your money, and the way you can do that is just by knowing the different types of ways to put your money in the stock market. In the stock market, you have two general ways that you can invest your money. You have a short-term strategy, ST, and then you have long-term strategies, LT. So when we talk about investing your money for the short term, this is actually trading your money. This means that you're going to buy and sell a stock within less than a year. We're talking about long-term strategies. We're talking about everything longer than a year. The way you analyze companies and find investments here versus here are very different. Here, when we're talking about investing and trading your money for the short term, what you're trying to do is not necessarily find the most undervalued company. It's not trying to find the best company or the most profitable company. It's just trying to find a company that's going to pop in the short term. This company might not be the best investment for the long term, but it could make you more money in the short term. In the long term, what you're doing here is you're trying to find a fundamentally strong company. It might even be an undervalued company where you believe in the long-term value of this company because you like the products, you think they're going to be innovating in the future, or this industry, this company, this technology is going to have more value in the future. So now you want to buy in because you want to invest this money for the long term. There are two very different types of analysis and two very different ways that you're going to invest or trade your money. When you are a trader, now you're trading your money to make money in the short term. You're trying to just find a hot stock, buy it before it pops, and sell it quickly. The thing that you have to understand here is you have to know your buy and sell targets before you even buy. So the first thing you want to do is okay, if I buy the stock and it goes down, at which point do I sell? Because the last thing you want to do is continue to keep holding your stock at a loss because you think it's a good stock. Remember, when you're investing for the short term, you just want to make a quick buck. You don't care about the long-term fundamentals of this company because you are a trader. Sure, it might be a great company. Sure, it might be a smart investment. But if it's not a good investment here, you got to know when to cut your losses. So what you might want to do as a short-term trader is tell yourself, okay, I don't care what's going on with this company. If my stock comes down 10%, I'm going to sell. Doesn't matter if I think it's a good company or not, that is my sell target. That way you have your risk management system in place. So if my stock goes down 10%, I'm going to sell. But I also need to have my sell target on the high side because now if I know it goes up by 50%, I should be selling as well. That way you know, okay, at this point I sell at the top, at this point I sell at the bottom. What you're doing right now is you are trying to take your emotion out of the equation because you want to know before you go in where you're going to sell at the bottom and where you're going to sell at the top, because once you get into it, your emotions can take over and they might say, oh yeah, the stock is going down, but I think it's going to rebound. Or if it's going up and you see the stock go up by 55%, you might think, I think the stock is going to go up 80%. I shouldn't sell now. And then of course, anytime that happens, the stock turns around and now you're down to a 20% gain or you lost all your profits or whatever happened. So you want to make sure you know know when to sell before you come in. And the research you're going to be doing here is all with stock charts. You're going to be paying attention to momentum, emotion, sentiment. And so these are the things that you're going to be paying attention to. I'm not going over all of these indicators in this video, but you're paying attention to the things that show you, is this company going to go up sometime in the next 2 weeks or the next 2 months, right? So you're looking for the short term. How can you make a quick buck? How can you flip these stocks? I am not a short-term trader. I am a long-term investor. When you are a long-term investor, what you're trying to do now is not make money over the next 2 months or 6 months. You're trying to make money over the next 2 years or over the next 2 decades. The strategy and analysis you do here is going to be very different than what you do here, because when you are a long-term investor, you don't even care about the stock charts. You know, those things that people keep showing on CNBC and on all those trading websites, those really fancy looking candles, stock candles, that's what they're called. You don't care about that here. What you're looking at here is the actual company fundamentals. How much money is the company making? What type of profits are they generating? Are their revenues growing? What are their expenses like? What are their future expenses like? What are their capital expenditures? What are they doing to innovate for the future? Who is the CEO of the company? How are they going to continue to sustain their market share in the future? So what you're looking at here is the actual strength of the company, not the stock. What you're looking at is how strong of a company is this right now, and how strong of a company will this be in the next 5 years and 10 years. So now when you are a long-term investor, you're really just looking at this company, their products, and how hard is it for them to continue to be a great company or become a better company. And one of the things that you can look at is how hard is it for another company to come in and take your company's spot. So this is what Warren Buffett calls a moat. How hard is it for another company to take over your company? And so what Warren Buffett likes to look at is companies that have a very big moat, because a big moat means it's hard for a competitor to come in and kick your company out, so your company is more sustainable. Because if your company can easily be kicked out by another company or a competitor, then you don't have a real advantage, or you don't have the kind of proprietary edge which keeps your company sustainable. So if you want to invest in a long-term company, especially if you're talking about years or decades, you want to make sure that another company can't just come in and take your company out very easily. You want to have the high barrier to entry for your company. So these are the things that you want to pay attention to in the long term. And when things go down here, the only thing that you should be doing, assuming that your fundamentals stay strong and that your company is still a good investment. So if you like the company is still producing, they still have revenues, they still have cash flows, and your stock is going down, the only thing that you should be doing is buying more, because the stock and the company, while they're similar, they're not always going hand in hand. And so if you really like the company and the stock price comes down, then all you should be doing is buying more of the stock at a discounted price, because you're investing for the long term, because you believe in the long-term value of the company. So if you don't have any sort of strategy for how you're trading or investing your money in the stock market, it might not be bad for you to step back while you're ahead and start to learn about the stock market. That way you can continue to invest your money profitably. The second reason why you might want to take a step back from the stock market is if your goal as a stock market trader or investor is just to get rich quick. The stock market is a place for you to invest your money into companies. It is not supposed to be a casino. And the thing that I want you to understand here is that while in the short term, yeah, it might look like a casino because people are buying up random stocks, or people are buying up hot stocks, making a lot of money very quickly doing this flipping, it's not always sustainable. I mean, yeah, you can make a lot of money gambling, but it's very hard for someone to sustain that sort of income for the long term through gambling. And so the thing you want to understand here is that while you might see people make a lot of money very quickly, you gotta be smart. One of the things that always concerns me is when I talk about investing, especially long-term investing, and I talk about getting 7 to 10% returns a year on your money, and people comment saying things like, 7 to 10% returns, that's nothing. I got an 84% return last month on my money. If you made a lot of money very quickly, I'm happy for you. That's a good thing. Now, I also want you to be smart with your money. That way you can keep your money and build long-term wealth. When you're investing your money in the stock market, there are 2 ways that you can make more money. You can make more money by taking on more risk, or you can make more money by investing more money. Taking on more risk would be doing some of the things that I talked about, doing some of the stock market gambling, throwing your money into hot stocks, hoping you can double your money in less than a year. Is it possible? Yes. Is it guaranteed? No. And so you gotta understand that, yeah, more risk comes with more potential return, but it's also risky. On the flip side, you can also make more money just by investing more money and having more money. If you only have $100 to your name and you invest all $100 in the stock market and you get a good 10% return on your money, well, you only made $10. But if you have $1 million to your name and now you invest $1 million in the stock market and you get the same 10% return, well, now you made $100,000. You got the same return both times, but because you invested more money, you got more money. This is where everybody says, okay, Jasprit, but how do I go from $100 to $1 million? Well, this is where you have to be consistent. You got to keep investing your money, and you got to keep compounding the money that you do make. So you make a profit, you keep reinvesting this money back in there, and you put more money into the stock market every time you get paid. That way we can kind of build the snowball that's slowly growing to build you wealth. In the beginning, it's going to be slow, but as you keep going and as you keep growing, you're going to see your money grow. So your money will be able to grow bigger because you have more money growing, and you keep adding more money into the pie by constantly investing more money into your investments. If you're not willing to be patient, that way you can grow your money over time and see your money slowly grow over time to build you wealth, then maybe you should take a step back, because if your goal is only to get rich quick, you want to stop while you're ahead. That way you can take a step back and just understand what your goals are, and if you do want to just see bigger returns, then spend more of your energy trying to earn more money. That way you have more money to invest in the stock market, because the people that get greedy, that are always just trying to chase a buck, are the first to lose their shirts when things turn around. The third reason why you may want to take a break from stocks is if you don't understand what your other investment options are. The stock market is one of the most accessible places where you can invest your money, but it's not the only place where you can invest your money. So you want to make sure you know what your options are, so you're investing your money in a place that's making the most sense for you. Another place where you can invest your money is in real estate. I love investing my money in real estate because real estate gives you cash flow. So with real estate, the way it works is you go out and you find a property. It might be a house, it might be an apartment complex, it might be an office building, it might be a mall, a shopping plaza. You go out and you buy this piece of property, you buy this building. Now, what you're trying to do is you want to have a tenant living in your property or using a property. That way every single month they're going to pay you rent for living or using your property. So if you go out and you buy a home, now instead of you living there, you have a family move in there, and this family is going to pay you rent every single month. And if you do it right, this rent is going to cover your mortgage costs, your taxes, your insurance, your maintenance fees, your vacancy, and it's going to put a little bit of money in your pocket every single month. So now you could be on the beach in Florida still collecting cash flow payments for your real estate investments. Now obviously the downfall with real estate compared to the stock market is you got to be way more involved with real estate than with stocks, because with real estate you're going to have to find the contractor and the property manager, and you're going to have a tenant in there, and so there's a lot of people involved that you may have to work with, versus with the stock market you can just put your money in stocks and not worry about it. Plus it takes a lot more money to invest in real estate than it does the stock market. Cryptocurrency has become a very hot asset class recently for a few different reasons. Some people like cryptocurrency because they like it as a way to make money quickly, because there's a lot of momentum going into cryptocurrency. Some people like cryptocurrency because they like it because they believe that this is going to be the future. Blockchain and cryptocurrency are going to take over, and so people want to buy in first. It's kind of like trying to find land where people are moving to. So they're trying to find and own this cryptocurrency before the rest of the world comes into cryptocurrency. So the advantage that you have with cryptocurrency is you are trying to invest in the future. The risk with cryptocurrency is it also comes with its own fair share of risks, because nobody can predict the future. Not to mention the fact that there's a lot of emotion and speculation in the cryptocurrency market, which means you can see your investment go like this. So if you can't control your emotions, that might not be a good investment for you. Another investment option you have is by investing your money in actual physical businesses. So if you don't mind being actively involved with investments, this might not be a bad idea. You can go out and you can invest in businesses that you know. You can go out and you can buy franchises. You can start businesses. There's a whole kind of range of businesses out there that you can invest in, and if you don't mind being physically involved and spending your time in it, then this can be something that you do. I mean, this can range from all sorts of things. You can go out and you can invest in convenience stores, 7-Elevens. You can invest in a UPS franchise. You can invest in a food franchise, restaurant franchise, or a fast food franchise. You can invest in vending machine franchises. There's so many different types of franchises out there in every single industry, from finance, things like opening tax companies, to your convenience store type of things, to legal, to healthcare. So there's so many different options here. So you just have to understand that if you are interested in actually being involved in a business, there are different franchises and businesses that you can invest in or own. That way now you're investing your money and your time. By the way, I'm not trying to promote any franchise model. I was just giving you a couple examples so you know what I'm talking about. Or you can invest in alternative investments. This could be commodities like gold, or even things like art. Art is an interesting investment because when rich people have money, they use some of their money to buy art. And so when there's a lot of money in the economy, you'll see the prices of art skyrocket because people want to use their money to buy art. And so now it makes that asset class, the art asset class, go up. It's not a traditional investment investment, but it is an investment for some people, and it has made some people a lot of money. I mean, art kind of works like every other asset class out there, where when you have more buyers in that market, it makes the price of this asset, in this case art, go up. And Deloitte even said that they expect the art market to go up to $900 billion by 2026. If you already have your money invested in traditional assets and you're looking for a way to diversify into something like the art market, one of the easiest ways to do that is by using someone like our sponsor Masterworks.io, who is the premier membership for investing in contemporary art. Now you gotta understand, art is not a traditional investment, but it does give you diversity, and over the last couple of decades or so, art has outperformed the S&P 500 by more than 150%. That's a huge difference, which might explain why you see something like 2/3 of billionaires allocate 20% of their overall portfolio into art, because they want that diversification. The tricky thing about investing in art though is if you don't have $10 million laying around, you can't just go out and buy an entire Warhol for yourself and put it in your room. I mean, you need a lot of money to invest in art. But thanks to Masterworks.io, you can invest in multi-million-dollar works of art by artists like Picasso and Banksy at a fraction of the entry cost to buy the whole piece of art. And the best part of all, if you are interested in learning more, is that Minority Mindset subscribers can skip their 17,000 person waitlist when you use our link in the description below. And if you want to learn more of the important information, you can learn more at masterworks.io/disclaimer. So if you want to learn more and see how you can potentially start investing in art, I got the link to how you can do that in the description below. So if you don't know what their other alternative investment options are, you might want to take a step back from the stock market. That way you can make sure that you're investing your money in a way that's best for you right now. The fourth reason why you might want to take a step back from the stock market is if the stock market is absorbing your life. Back in the day, the only way that you would get stock market information is if you read the newspaper. So you'd only be getting stock market news once a day in the morning with your daily newspaper. Then came the advent of 24-hour news, and even with 24-hour news, the business and financial news was only on like 9 to 5. Even right now, like CNBC is only playing financial news for a chunk of the day when the market is open. And then after that came the internet, where now you can engross yourself into the stock market 24 hours a day, 7 days a week. And so now you have people that are constantly glued to Reddit and YouTube and Discord and TikTok and Twitter trying to get the stock market advice. And yes, people do get stock market advice from TikTok. Now that's one thing. I want you to be educated about what you do. And if you're feeling anxiety about what you're learning, feel free to take a step back. But the second part of that is you have a lot of people that feel like they're missing out, that they're not getting the gains that some people are, because on the internet, you have a lot of people that boast about their gains. I mean, if you go to Reddit, you have people talking about the YOLO portfolio of people just throwing $300,000 into a stock. And everyone's wondering, where in the world are people getting just $300,000 out of nowhere, where they can just take $300,000 and throw it all into one stock? And then you have people on the internet selling courses, talking about how they're able to turn $40 into $2 million overnight. And this can create a lot of anxiety, because you're thinking, what am I doing wrong? I'm reading all the news, I'm trying to get educated, I'm trying to do all the things right. That way I can make more money, and you're not doing that. The first thing that you got to understand is that with the stock market, like anything else, it takes time to learn and understand, and it really takes time to make serious money. Everything has a learning curve, including the stock market. So if you really want to make money in the stock market, you got to understand that it's going to take time to learn how it works. There's going to be times where you lose money, and you got to figure out how the process works. So you got to give yourself the time for that. The second thing that I want to make sure you understand is that there's two ways to make money in the stock market. You can make money actually trading and investing your money in the stock market, or you can make money by teaching other people how to trade their money in the stock market. It destroys me when I see somebody make their first $10,000 or $100,000 in the stock market, and now they think they're a financial genius. They think they're a stock market genius because in 12 months they were able to get a 40% return or a 200% return, and they've only been investing their money for 12 months. And now what do? You turn around and you start marketing a class about how you, a regular person, can get 100% returns, and how you can make $100,000 in 12 months, even though you have never seen a bear market in history. Now let me make sure this is clear. There's nothing wrong with selling classes on the internet. There's nothing wrong where if you have a skill set, you know how to do something, you're selling it on the internet. There's nothing wrong with buying education on the internet. I spend a ton of money on classes on the internet, and we even have a very good stock market class taught by somebody who has spent a lot of years and a lot of time and a lot of their own money learning how to invest their money and trade their money in the stock market. What I'm trying to say is that there's a difference between doing that and just making a little bit of money, and now you create a hype class hoping that you can lure people in with the whole idea and hopes and the dream of trying to sell people on the idea of getting rich quick. So if you feel like the stock market is absorbing your life, either because you can't handle all the content out there and it's just becoming overwhelming, or because you feel like you can't keep up and because you're not getting the returns that other people are getting, or because you're not getting the returns that other people that you know are seeing, then maybe it's time for you to take a step back and just understand what you're trying to do in the stock market. This goes back to everything else that I talked about in this video. Why are you investing your money? What is your strategy? What are your goals? And are your investment or trading strategies aligning with your goals? So it might not be a bad idea for you to step back and just look at your finances and understand what you're really trying to do. And the fifth reason why you might want to take a step back from the stock market is if you're living off of headlines. The thing that I want you to understand about this is that the media is in the business of selling hype and emotion. And you gotta be smart here, because the media is not in the business of selling financial education. The media wants to get you into the whole idea of getting you riled up, of getting you triggered, because that's gonna get you stuck onto them and make you watch them, and that's gonna make them more money. Right? And so the thing that you got to remember about this is that the media is not your financial education. You really saw the power of this in 2021 after the whole GameStop phenomenon, because you kept seeing people on the internet talk about how they were going to do a certain buy of a stock or a cryptocurrency on a day and a time. And then the media would come in and say, oh, everybody on the internet is going to buy this stock or this cryptocurrency on Wednesday at 11 o'clock a.m. And what you would see happen is that leading up to Wednesday at 11 a.m., you'd see the stock or cryptocurrency rise. And then when that buy happened, it might go up a little bit, but then it will come crashing down. Do you remember when Elon Musk went on to Saturday Night Live to talk about Dogecoin, Dogecoin, Dogcoin, whatever you want to call it? And everybody kept saying that this coin was going to go to the moon after Elon Musk talks about it on Saturday Night Live, and then he went out and he talked about it, and then the coin came down. The reason why is a very old saying in the investment world: buy the rumor, sell the news. By the time the traditional media has talked about something, it has already become old news, and so now if you're buying something based off of what you're seeing in the news today, you've already missed it. And on top of that, when the media likes to talk about things, one thing that I like to keep in mind is that when things are good, it's usually not as good as most people and media likes to make it seem, and when things are bad, it's usually not as bad as most people and the media makes it seem. Remember, the media is in the business of selling hype and selling emotion, and so for them to get you hooked, they gotta put a little salt and pepper on what they're saying to make it seem more intriguing to get you hooked in. And so that's something you want to keep in mind, because yeah, this news can be important for you, but you just gotta remember that when it's good, it might not be as good as everyone makes it seem. When it's bad, it might not be as bad as people make it seem. So you gotta be smart here, and you don't want to be the person that's just living off of headlines, because headlines can be deceiving. They can make you emotional. They can make you want to buy. They can make you want to sell. But you want to be a smart investor that's investing on financials, not emotions, because the people that make the most money in the market, doesn't matter which asset class we're talking about, the people that make the most money in the market are people that invest on financials, not emotions. If you cannot control your emotions and you are always investing your money based off of headlines, maybe it's time for you to take a step back and just monitor the market and just understand what's going on and just watch things without your money involved. That way you can kind of build that discipline, so you're not just constantly throwing your money around in panic or in fear or out of emotion and excitement. You want to be a smart financial investor, not an emotional one. Thank you for watching. If you enjoyed this video, here's a video on things you need to know about building wealth in the market that I think you'll love, and while you're at it, download our free stock market PDF, and as always, keep hustling. One of the things you can do is to follow our 75, 15, 10 plan. What that means is for every dollar you earn here,